over the years, I saw that there was a missing area of education. There were Canadians looking to move abroad, receiving misinformation on Facebook groups, random individuals who were not
Ready,
accountants
like
or
how
experts.
much of a takeoff runway before they actually make the move?
A lot.
Yeah, great question.
How does Canada figure out your residency?
First, I want to make a note that it's not a choice. People come to, so we hear about the big scary departure tax, and it may be so much money when people leave Canada, but has been contributing to his TFSA for over 10 years.
That's a no-no.
He's been contributing, and all of a sudden he received a $26,000 penalty notice because the rule is any contributions made as a non-resident, there's a 1% penalty per month as long as the excess funds are in the account. So
if you have an investment property, you might be thinking, oh, great, okay, and I'll just keep on getting my income. And no. There might be some tax implications on that.
Yes. I'm happy to chat about this because this is a huge area of taxation when Canadians move abroad. So one is called T1161 list of technically it's called T1159 income tax return for electing under Section 216. It's called 45-2 election. Option 2 is called Form NR6. You must have and do you have any questions about the process?
You know what? I'm so happy that these forms roll off your tongue. Awesome. Hey, my name is Serge Chertescu. Welcome to the channel. This is the Canadian Expats channel, where we create content to help Canadians who dream of living, moving, or retiring abroad partially or permanently. I'm on that journey myself, and I'm really excited to be talking today with Ruby Chouhan from 360 Global Tax. We're gonna talk about really exciting stuff. Taxes and how that affects you if you're deciding that this is part of your life and your adventure. So welcome, Ruby.
Thank you for having me here today. I'm really looking forward to this in-depth conversation.
And before we get into it, I want to let you know that even though I'm a financial planning professional in Ontario, Canada, what we're talking about today is information that we've come up with together, but you should be still talking with your own financial professional or accountant to make sure that it relates properly to your specific situation. Do not take anything that you hear today as specific advice to you. That's a no-no, okay? So just make sure you check in with your professionals. So Ruby, when I meet new prospective clients, which, we're getting to know each other, I usually say there's 3 things that we want to do. We want to see if we like each other, trust each other, and we can work together. So I'd like to get to know a little bit more about you and 360 Global Tax. Tell me your story. How did you get here to helping Canadians with their international tax?
Thank you for asking. And this is a very random, interesting, I would say inspiring story as well. I'm born and raised Toronto, Canada here. I've lived here all my life, and I was in university. I went to Ryerson, downtown Toronto, and I was working part-time or full-time at that time in property management. And randomly, I was working with a lot of Canadian expats and helping manage their properties, do some tax items within the property management company. And I was lucky enough to turn that into a position at a big international tax firm where I worked there for over 5 years. And now I've been helping non-residents in the niche area of Canadian tax and international tax for about a decade. And over the years, I saw that there was a missing area of education. There were Canadians looking to move abroad, receiving misinformation on Facebook groups, random individuals who were not accountants or experts in their area. And I had this feeling in my heart that I had learned so much and I had worked with individuals across the globe. My own clients would come to me and say, Ruby, why don't you do this yourself? You're so well-versed. You help us all. I was pretty much an account manager to almost 1,000, hundreds and hundreds, close to 1,000 Canadians living and working abroad. And I took the chance and I partnered with my business partner and we launched 360 Global Tax about 4 or 5 years ago. So now we've helped over 1,000 individuals move across the globe, 30 plus countries, Denmark, Australia, Spain, UAE, etc. And every single day I feel really, really proud that I'm helping people live their dreams across the world. And I come across situations where someone might have seen me on a podcast like this. And actually, I'll tell you a personal story. I had a potential client who is my client now, and she told me she watched me on a YouTube video. And her daughter sat down and watched the video with her, and she felt so proud to see a woman, a business professional, confident, strong, and a great example for her. So that feels great in my heart, outside of even tax, being a mentor, someone to look up to people. And that's how I got here. And now I wake up out of my sleep and talk tax. And I'm very lucky to travel the globe, meet my clients across the globe. And on top of that, over the years, I'm fortunate to become a member of various Canadian business councils and chambers across the globe, such as Canadian Chamber of Commerce, Canadian Chamber of Business in Mexico, Canadian Business Council of Dubai and North Emirates, etc. That's a little bit about me. Any other questions?
Yeah, I mean, actually, thank you so much for sharing that. And I have noticed from some of the videos I watched on your YouTube channel, you've been in Dubai. You were like a guest speaker at some international conference, like really impressive.
Thank you.
You must know your stuff.
Thank you. I do. Luckily, I do. And I feel I'm a little bit different than many individuals. I believe in transparency and education. I'm very clear and transparent about rules, processes, etc. with my clients, what's happening with their situation. I believe in educating others, but leave the work up to the experts like ourselves who work with CRA every single day, who deal with convoluted situations. And yeah, so I am very lucky that I've had speaking engagements in Dubai, I've been to Qatar, Mexico, all over, a lot of places. And we're planning to go to Singapore soon, hopefully, and also Spain. We help a lot of individuals move to Spain, retire, move abroad for work, etc.
That is awesome. I'm going to pin that because a lot of people that I work with see Spain as a main destination, other places as well. But can I ask you a little bit about, so from the perspective of the services you offer, how does that work exactly? Like, is it a Canadian living here, you deal with their taxes in Canada, obviously,
Yep.
if they were to go, and you talk about whether, I'm assuming here, whether they're going to be moving permanently or not. But what about the taxes in like Dubai and stuff? Do you partner with other accountants?
Good question.
Right.
So what we do, I would say, is broken into multiple steps. One, someone's figuring out if they're actually going to move or not. Is it a permanent move? Is it for retirement? Is it for work purposes? Or is it a short-term work contract, maybe even less than a year? So step one is consulting, looking at the individual's entire situation, discussing their tax implications as they move, before they move, what steps they should take to, let's say, minimize ties. If they have a rental property, investment accounts, foreign property. Some individuals move abroad and still have employment income coming from Canada. So step one is making sure all the T's are crossed, I's are dotted, all potential situations and implications are discussed. That helps someone that helps someone properly plan their departure and then what's required as they're moving, right away as they move, because some requirements can kick in right away, or after they move, what are the actual filing requirements? And some people may have ongoing filing requirements as well. That's part one. And then when someone moves, they could be moving to a country that has taxes, such as Spain, or a country that doesn't have any taxes, such as UAE for personal taxes. So in those situations, we will work with their accountant on the other side in case we need to share across any Canadian income information or foreign tax credits they paid here in Canada, vice versa. So we help individuals and we work with individuals overseas. And I'm a big believer in working with experts only. So if I do refer anyone in another country, it's someone I trust that they will be well taken care of.
You've already vetted them and met with them maybe a couple of times. So just for my viewers here, like to see, like at what point would you recommend that they contact? So we'll get into the nitty-gritty of all the taxes and everything, but I really want to get to know the process that you go through.
Yeah.
So if they're just kind of thinking about it, but they're not even close to going, would you say that it's a good time to talk with you? Or when they're almost ready, like how much of a of a takeoff runway before they actually make the move? Should they be talking with you?
Great question. I have individuals who come to me a year before. Maybe they're planning their retirement in a year and a half, etc. I think it's good. Well in advance is great, or at least 3 months in advance. That because there's so much misinformation, and what if you don't know what you don't know, or what to even ask? That may sway your decision into moving earlier or later, or maybe selling property before you move or after you move, and it may impact those serious decisions. So I would say even if we meet a year in advance, we can always do a follow-up call to check if your situation has changed before your departure. Otherwise, at least 2 to 3 months in advance, in case there's any very important decisions you need to make with property, moving funds across, or the timing of receiving income from potentially your foreign employment, things like that.
Yeah, I like to say that in my experience, the math part is probably the easiest once you know what it is. But when I've worked with other clients that are thinking about this, I've learned that there's financial. They need to know the tax implications, what happens with their investments, what happens to their rental properties. But there's also logistical. Am I moving all my stuff, or am I not moving all my stuff? Am I starting again? And how does all that work, right? And then there's really, actually, I think the most important out of all of that is emotional.
Yep.
Because why are you moving? Is it because you're trying to escape something, or you're trying to get somewhere?
Yep.
And I found in working with some clients, they're so adamant to go. We make a plan. Like I worked with one couple that we're going to move to Europe in 5 years. Great. We do the financial plan. We talk about all that stuff. And then a year later, they're, maybe we're going to move in 3 years. Okay, because now something happened that they didn't really like. And then 6 months later, they'd call and say, we're not moving right now anymore because our kid just got accepted to some major university in Canada, so we want to stay here for that. And it's always this roller coaster. So the emotional is typically something we try to figure out first. Even what are my family going to say? What are my friends going to say?
Yeah.
Some people are very secretive about it too. Like, I don't want to tell anybody until I move. And then it's like, what are you doing? You're leaving? You're leaving us?
Yeah, it's exciting, and then your life changes, but then you're this international world traveler living abroad and having these experiences. And sometimes, while someone's living here, they may not even visit their family or friends for months at a time. But when you move abroad, you can make intentional plans, maybe go on a holiday, spend that intentional week or two together. And
I'm on the same wavelength as you are. When I first started in this kind of sector or industry, for myself, actually, I realized there's not a lot of cohesive information, how all the pieces go together. Your finances, your taxes, your emotional, and which is one of the main reasons we started this channel. But it can be put together. It just needs some good thought. And like you said, if you don't know what you don't know. For example, if you have an investment property, you might be thinking, oh, great, I'll move over to Spain or Dubai and I'll just keep on getting my income and no worries about it. Until you find out, well, no. There might be some tax implications.
Yes.
I didn't know we're going to start with this, but maybe I'd like to know your take on that.
Yes, I'm happy to chat about this because this is a huge area of taxation when Canadians move abroad. So often, I would say 90% of individuals keep their Canadian properties as they move abroad. They often convert their principal residence to a rental property, or they may sell it in future. There's different reasons, our real estate industry grows. Maybe somebody wants to take out the equity, grow their real estate portfolio, and come back to Canada in the future. Or maybe they want their kids to live in one of their properties in the future, or maybe they'll come back to Canada and live in the property as well. So there's multiple considerations to make when it comes to real estate. One, it was your principal residence. So a key item is in Canada, we have principal residence exemption. Anytime you're a Canadian tax resident living in a property, the principal residence exemption applies on capital gain, meaning you are exempt from paying tax on any capital gain as a principal residence. And that is for the number of years lived in a property plus 1 year. However, as you become a non-resident, that property will no longer qualify as your principal residence. And in future, those years it was not occupied as your PR, there will be taxable capital gain. So, for example, let's say someone moves from Canada. One, on what we call a part-year departure return. When someone leaves Canada, it's a different sort of tax return with disclosures about property ownership, fair market value. Something called a deemed disposition may happen, and actually real estate is excluded. However, we have to disclose the fair market value of the property, even though there's no real tax payable on the deemed disposition. So we have to fill out these disclosure forms. One is called T1161, list of properties by an immigrant, and failing to submit this form is a penalty of $2,500 per taxpayer. So step one, very important to disclose property ownership. We don't want you receiving hefty penalties, $5,000 for a couple that owns a property jointly. Two, when someone changes the use from principal residence to rental property, when they leave Canada, we're able to submit an elective form. It's called a 45-2 election, an election to inform the CRA of a change in use. And when a taxpayer submits that, it allows the CRA and you to benefit from that plus 1 year when you leave Canada. So rather than seeing the change, the fair market value deemed disposition, and using the fair market value of when you left Canada, you're still able to get that plus 1 year rule with the principal residence exemption. So that's a potential very important form to file when you leave Canada, 45-2 election. Now we've dealt with the departure and you've turned the property to a rental property. Now, if earning rental income, very, very key, you have to withhold non-resident tax and file tax returns. And you can't skip the step of withholding tax and just file a tax return, because I can understand that position. We don't make a lot of money on our rental income. Maybe you're in a loss at the end of the year. So you feel like, why would I have to pay CRA up front if I'm going to be in a loss anyways and not have to pay tax at the end of the day? But once you become a non-resident, there's various divisions that come into play. There's a division called Part 13 and non-resident tax. That requires non-resident tax be withheld depending on the sort of income you receive. This could be rental income, dividend income, interest income, pension income, etc. And you can't skip the step of withholding tax, or CRA may assess a final tax liability of 25% of the gross rent, which is huge. Imagine you make $10,000 a month or even $2,000 a month. That's $500 in a penalty, $6,000 for the year. So we don't want to miss the step of withholding tax. So if you're a non-resident earning rental income, don't worry, it may sound convoluted, but we take care of all of this. And I'm going to explain it in a very step-by-step process, but a little high level. So option one, we call the default option. The non-resident division requires you pay 25% of the gross rent as tax withholdings. I'd say less than 5% of people do this because no one wants to pay 25% when they have mortgage payments, property taxes, etc., and your money's tied up with the CRA. However, in that process, you're paying 25% every single month. The following year, you receive a non-resident tax slip showing how much tax you paid under that account. And step three, because you withheld 25%, CRA allows you to file your non-resident rental return. Technically, it's called T1159 income tax return for electing under Section 216. They allow you to file it within 2 years because you'll always be in a refund position. So they're not in a rush for you to file your tax return. Typically, your taxes are due April 30th, but in this manner, they know you won't have any tax owing, so they give you up to 2 years. That's option one. Most people don't go with that option. Option two is called Form NR6. You must have a third party, such as our Canadian tax firm, registered as a tax withholding agent with the CRA's non-resident division. And the NR6 form, it allows you to pay 25% of your estimated net income. So imagine you're estimating a loss for the year. You can end up paying $0 in tax compared to that huge 25% of the gross rent. The process is broken down into 3 parts. Part one, until you file the NR6 form, you have to pay 25% of the gross rent. So as an example, our firm for the upcoming year, we start preparing NR6 forms in November. So all of our clients are approved effective January 1st to pay reduced taxes. We prepare your NR6 form. It's almost like an estimate tax return. You sign off on it. We sign off on it as your Canadian tax agents. The rest of the year, no more forms or payments. If there's a payment due, we request you make a one-time payment to our non-resident account. That way you don't have to worry about monthly payments. We don't have to worry about following up with you every month as well. Then we put our mailing address. We make sure everything's approved correctly. We receive your mail from CRA, etc. The following year, we prepare your NR4 slip, non-resident tax slip. It'll show an exemption code showing you were allowed to pay less tax. And step 3, CRA has a very strict tax filing deadline of June 30th of the following year. Because they allowed you to pay less tax, they want to make sure your tax return's filed in a timely fashion and any tax is paid that's due. However, if you fail to file your tax return by June 30th, CRA cancels your NR6 form and comes after our tax firm as your Canadian tax agents, and they issue a final assessment of 25% to the gross rent plus arrears interest. So we have this process set up very well in-house. We don't want to receive penalties. We don't want you to receive penalties. Everything is like a well-oiled machine, and we do this for close to 1,000 non-residents, I would say, across the globe. And do you have any questions about the process?
Yeah, you know what? I'm so happy that these forms roll off your tongue and you really know your stuff, I can tell, because, it just goes to show, I think, how important it is to speak with a professional that can understand your situation.
Yeah.
Because that's not going to be relevant for everybody.
Yeah.
Right? So, one thing I keep on saying over and over and over again, if you don't know what you don't know, which a lot of us are in that situation about this move, talk with someone like yourself to understand and give freely of your information. Like, don't hold anything back, because there might be something that you are aware of that's not. And this is a topic that is probably going to be near and dear to a lot of people, and it opens up so many other questions.
It does.
It talks about what's your residency. It talks about filing taxes if you still own property here.
Yeah.
Like, some people are thinking, I'm leaving Canada and now I don't have to worry about filing taxes there anymore. But in some cases you still do if you want to take advantage of, tax treaties and so on and so forth. Some are just thinking, I'm going to move to Dubai or Spain or Italy or Portugal and I'll be resident there. I'll file taxes there. There's a lot of stuff. So maybe I'll just kind of ask maybe the question that is on a lot of people's minds a lot. Yeah. How does Canada figure out your residency?
Good question. This is a great question. And also I want to mention that, everyone is an expert in the area they're an expert in. So when people talk to me, I understand I can sound very technical and it sounds like tax jargon and to everyone. So while I explain technically, I always like to sum it up high level. Even with the rental items, ideally, we can help you submit forms so you're paying as little tax as possible. And at the end of the day, tax as little as possible as well. And our goal is to help you pay as little tax, be compliant, and make sure any tax deductible items, etc., can be included. And just to add to the rental portion, a huge benefit to rental property owners is that almost everything related to their rental property is tax deductible. Mortgage insurance, property taxes, mortgage interest, accounting fees, leasing fees, etc. So at the end of the day, you could end up paying very little tax on your net rental income. So while it sounds like a huge process, it can be well taken care of, where you don't have to do much and we follow up with you, everything's filed, we let you know exactly what we need from you, and you can always ask us as many questions as you need.
All I hear from there is that, so maybe I can get an income while I'm living my life in Spain and not have to worry about it.
Absolutely, absolutely.
That's awesome.
And to answer your question, how does CRA actually figure out someone's residency? First, I want to make a note that it's not a choice. People come to me and say, oh, I'm going to move short term for 2 or 3 years and I'm planning to come back. I still want to be a resident. It's not a fact. It's not a matter of choice.
Not what you want.
Exactly.
There's the rules.
It's based on your circumstances and the facts of your situation. And when we look at tax residency, residency is not clearly defined in the Income Tax Act. And that's because everyone's situation is different. Some people are traveling often, may own properties in multiple locations, may have businesses in multiple countries, etc. So even when we look at court cases and precedent, it's vague. Essentially, it says, where does your heart and mind and intention lie, which is not clear. So with the CRA, we've come up with a set of ties that we look at. We consider primary ties and secondary ties. And these are not always black and white. Someone's entire situation has to be looked at. So primary ties that we consider the strongest significant ties that would default you into being a tax resident. One, where is your spouse or common law partner? As an example, if you decide to move 2 months in advance, now you're living in Spain and your spouse or partner is still here, typically until they leave, you are still considered a tax resident of Canada.
Gotcha.
Two, so it may be important for the whole family to leave together because there may be some impact on taxation, meaning if you're earning foreign income until you become a non-resident, your worldwide income is still taxable in Canada. So the timing of the departure. Two, children, dependents. If you have custody and your children are here and you're traveling, quote unquote, digital nomading or working abroad, your children are a significant tie.
What age though? Up to what age? Like your age of majority or?
This is a good question. And actually I came across the situation recently. It's not 18. Typically it is 18, typically when it's dependents. However, there can be certain extraordinary circumstances. Let's say if a child has a potential illness or a disability that needs to be taken care of. So it's case by case, typically 18 dependents, but it really depends on your situation.
That makes sense, of course. I mean, if they might be dependent, but would it be like a 25-year-old who hasn't found a job and
No.
they have to like
No.
have money from
Luckily,
mom and dad?
no. They're an adult and they're not seen as your dependent.
Okay.
So luckily, no. Typically, we're considering 18-year-olds.
They're probably the digital nomad already left Canada doing something else somewhere.
Exactly. They're probably maybe the kid living in the basement that's
Yeah.
traveling around and coming back to their parents.
Okay.
Three, real estate. Meaning, are you keeping your real estate available for your use? Are you using it as your primary home when you visit Canada? The length of stay in the home? How often do you visit Canada? That's a primary tie as well. So those are significant.
Okay.
Now, sorry, go ahead.
Yeah, about that, I just wanted to clarify because some people might think, okay, well, I've got my primary residence. I'm not going to use it. I'll rent it out. But so as long as there's a renter in there, it's not considered like you can go back in because you basically you have nowhere to stay unless you kick them out somehow or ask them to leave.
Ideally, it's rented.
Right.
Ideally, you want to have it rented, or if you're planning to
What
sell
if
it.
it's Airbnb? Sorry.
Airbnb, that's totally fine too.
Really?
Yes. And
That's
something to
interesting.
keep in mind, if you convert your property to an Airbnb property, it's considered a short-term rental operation, meaning rented for 30 days or less. GST, HST requirements kick into play.
Oh my
in
goodness.
addition to the non-resident tax withholding requirements. So if you earn 30K in any 12-month period, not calendar year, but 12-month period, you must charge GST, HST. You have to set up a GST, HST account. And what that also means is that GST, HST you pay on your expenses for the property, you can use that against the GST, HST
Just
you've
gets
charged.
a lot more complicated.
It does. Another consideration is if you do have Airbnb property, it can be considered business income and business property, which is taxed different when you sell, meaning rather than a capital gain, it may be taxed as business income. So there's different considerations. And also outside of income tax, for example, here in Toronto, when you have a short-term rental, you have to have a license with the city. So depending on where in the country you are, depending on the city or the province's rules, you may have additional licenses or short-term rules that you have to comply with.
That's a good point. And actually it takes me back to really the foundation before you even start, like, clients that come to me, we start on the financial planning side, right? Clients come directly to you, you're talking about the tax. But realistically, we're talking about, what's the reason you're moving there and what's the income we need to generate to have you there without any worries anymore.
Yeah.
And maybe you don't have to rent. Maybe you just sell everything and maybe you have a rental condo, but you sell everything and just keep that. But it starts with that question of, if you need, if you're a Canadian, born Canadian, and you don't have a European visa, like some people that move back to Europe because they have residence, they don't have to worry about visas.
Yep.
But recently I interviewed a tax accountant lawyer in Spain, and she explained to me how for the non-lucrative visa, they need to have like close to 58,000
Yep.
Canadian in a bank account,
Yep.
right? Just to get that started. And then they can use that for income, but what about other stuff? Like, okay, great, I'm going to Spain, but now what? I can't go out. I can't have a I can't go eat tapas, no matter how cheap it is, because I don't have enough income. So we start there and we say, okay, well, now we've got this, but we've got your investments in your RSPs, which is another topic we're going to talk about, because what happens with that withdrawal from RSPs and TFSA, whether they should have a TFSA. So many topics to talk about, really. But it's getting all that information, putting it into like a pile, and then sifting it through and seeing how they all connect together, right?
Yeah, exactly.
So the residency thing has always come up, always. And that can be something that sometimes can make clients change their mind to say, you know what, I want to be a resident of Canada, or I don't want to be a resident.
Yes. Well, actually, allow me to circle back to when we were talking about primary ties. Those are primary. We also have to look at secondary ties and everyone's entire picture again. So when we think about secondary ties, those are your supporting ties to figure out if you're a non-resident or tax resident of Canada, such as driver's license, healthcare, memberships, religious memberships, magazine subscriptions. There was actually a court case where someone's golf membership was looked at as an additional tie. It's not black or white, but you want to minimize as many ties as possible.
Cancel the golf. Cancel
it all. Cancel as many as possible, because you're showing intention that you know you don't need these memberships, that you've canceled healthcare, that you've canceled driver's license. Typically, and it's not black and white. Just because you don't cancel one thing doesn't mean that automatically negates that you're a non-resident for tax purposes. As an example, people often keep their Canadian driver's license when they move to other countries to switch into the other country's driver's license. And then they may let it expire, or they cancel their Canadian one. And when it comes to healthcare, if you decide to move back to Canada as a Canadian tax resident, it's very easy to re-enter the Canadian healthcare system. And there's been court cases where, let's say, or situations where someone has lived outside of Canada for 5 years, they work elsewhere, they're coming back and forth, they didn't cancel their OHIP. In Ontario, we have OHIP, and they were taking advantage of surgeries, medical, doctors' visits, etc. That is such a strong tie, your healthcare, that person was deemed a Canadian tax resident and had to pay Canadian taxes on their income. So it's very important to minimize your secondary ties as you're planning your move. As you move your, Apple account, Netflix subscription, etc., to your credit cards over there. So these kind of things matter too, because it's not black and white, and everyone's situation has to be looked in detail.
I can just imagine most people will not cancel their. I'm just guessing here, because number one, they don't think about it. Number two is like canceling can be like a painful decision, like. That's an emotional side again. I'm actually doing this. I'm leaving, right?
Yeah.
And what if I get it back? But I think there might be even repercussions. I mean, you might have a driver's license with your home address, which you've now sold.
Yep.
And now all of a sudden you have an identity card with a home address you no longer have anymore. The government body that's renewing, they might be mailing you something and it's going into the atmosphere.
Yep.
So. And the Netflix, like all these different things.
There's a lot to consider.
Yeah.
And even
but what about bank accounts and all the?
Great question. I was just going to mention that because you mentioned address.
Yep.
As a Canadian, when we think about residency, we're not looking at it as an immigration perspective. Canadian citizen, you're always a Canadian citizen. We're looking at a tax residency perspective. Someone can be a non-resident for 2 years or 20 years. So those Canadian bank accounts are important, especially if you have long-standing relationships. You may come back to Canada. Maybe your pension is going into your Canadian accounts. You have investments. It's important for you to disclose to your Canadian banks that you're a non-resident and where you live now. Typically, there is a tax ID form that is filled out by individuals. Banks need to know for their compliance requirements where you live in case they need to issue you non-resident tax slips, NR4 slips for investment income, dividend income, etc. They need to know what country you live in so they can apply tax treaty withholding rules, because depending on the country you live in, it may impact how much tax is withheld on your investment income. So I would say don't cancel your Canadian bank accounts. Advise your Canadian banks of where you live. However, when it comes to credit cards, it's different. We want to consolidate as much as possible, because you shouldn't be using your Canadian cards like you live here, and you shouldn't need them anymore. So those are my
Okay.
recommendations.
All right. Yeah. So I have had a case where we've had client move over to Spain, and we did put the new address in to the system, and that initiated a form that I had to send to them to confirm where they were, so that we could issue NR4 forms. Now, I'm not sure if you want to talk about this or not. I've highly recommended against this, but I've come across people that will say, well, I sold my house, but I'm using my mom's address, or I'm using my friend's address. And that's what I told, even though they don't live there, even though it's just not even their address, right? And I never knew the rules, but I said, I don't think that's a kosher idea to do that, because I'm guessing you're kind of trying to play the system a little bit. Do you know anything about that? Can you talk about that?
I have a little bit of a story, and what I'll say is there's a difference between mailing address versus them knowing your actual address.
Okay.
It's okay if there's a care of mailing address,
That's a good
as
point.
long as the bank or whoever, the payer of any sort of income, such as Questrade or another sort of interactive brokerage account, knows where you truly live. I have a client right now. He had an account, and to add to that, depending on the company, for example, Questrade allows non-resident account holders, whereas Wealthsimple does not allow non-resident account holders. He gave his mother's address, didn't inform them that he lives in Qatar right now, and has been contributing to his TFSA for over 10 years.
That's a no-no.
Yes. And
That's big penalties.
Yes. So all these years he's been contributing, and all of a sudden he received a $26,000 penalty notice, because the rule is any contributions made as a non-resident, there's a 1% penalty per month, as long as the excess funds are in the account.
Yeah.
So who knows when someone will actually figure out, oh, you're a non-resident for tax purposes and you're contributing, huge penalty. We're asking for forgiveness. CRA's been working on it for about 4 months now, praying CRA forgives it, because it was actually an honest mistake. However, they're hard to forgive these kind of situations, especially if you ever over contributed to your TFSA or if you ever received a notice before. So it's very important. Anybody that's paying you any sort of income, they know what country you live in and that you're a non-resident for tax purposes.
Yeah, so it comes really down to the foundational piece of anybody thinking about this move is to consider where you want to be resident, and then understanding it's not really your choice. It's based on the primary ties, secondary ties, and following the rules, basically. So.
Yeah, and everyone's situation has to be looked at individually, because little nuances can change your situation. And just to add to the TFSA part, and you brought this up earlier, if it's an advantage to keep it or not.
Yep.
So this is case by case, and I come across this question often. It really depends. Imagine you're moving to a country that doesn't have taxes, such as UAE. That means you don't have to report your foreign interest income, TFSA income, to any tax authority there. But alternatively, in countries such as Spain, they don't recognize TFSA as tax-free. So I often see clients withdraw from their TFSA and reinvest elsewhere, because they'll be paying tax on capital gain over there,
Right.
etc. While here on the Canadian side, tax-free continues to be tax-free withdrawals in future. So it's still a benefit here on Canadian side, but you have to determine on your side, whichever country you're moving to, if it still makes sense to keep it.
I mean, I've been thinking about this because I've heard this over and over. Get rid of your TFSA, and I always hate these like black and white thing, like get rid of it, right?
Yeah.
Like you must use an RSP. Like it's not actually the case.
No.
You have to look at it. And I've been thinking that if, let's say it's a couple, right now they could have a couple of $100,000 if they maxed up both their TFSAs, right?
Yep.
It could be part of their estate planning. They could have their kids as beneficiaries, you know?
Yep.
So if they move to Spain or Italy or Portugal or somewhere where it's not considered, okay, yes, they'll pay taxes, but they would also still pay taxes if they took it all out and put into a non-registered account. It's still the same idea, but they lose the estate planning. of their beneficiaries. So I always tell clients, like, think about what it is. Do you need the money from the TFSA?
Yep.
Or is this part of, like, you want to make sure that if you die overseas, your kids are going to immediately get something, because in Canada, they'll get the death certificate and move the money over to the children's without having to go through the will and everything. We're not going to talk about estate planning because you're an accountant, but there's a whole thing about wills, whether you need one in Spain or wherever you are.
I was going to say,
and in Canada, right?
It's such a big part moving across the globe. There's so many different factors: accounting, investments, foreign exchange, shipping your items across. So that is a fair point.
Yeah, and about you mentioned something a bit earlier that really strikes a chord with me. You said some companies don't allow non-residents and some companies do.
Yep.
And I've had a lot of discussions with people that have said, I've gone to my bank and they said, oh, well, we can keep it, but you have really a lot of restrictions on what you can do with it, right? And that's true. Being a licensed financial planning professional, I know that where we're licensed, if I'm licensed in Ontario, I don't have an office in, Malaga, Spain, or Dubai. So technically, I cannot talk about financial planning to anybody if they're not in Ontario.
Yep.
And if I do that, I could get in trouble. My company can get in trouble through the securities laws in that country, right? So how do you get around that? Like, most people are coming to us for advice on, like, how to invest and how to make sure. So one thing I'll just add a little bit of a tip here is, and again, this is not a recommendation, talk with your financial planner, but if you're going to keep the money here in Canada because you don't know what you're going to come back or not, like, and converting it all to euros or whatever the currency is, you might be losing on that. And how does the banking system work there? What the investments are like there? Maybe you need a couple of months to get your footing. Well, you need to find a company that can hold your account, number one. So make sure you call your financial institution. Number two is you need to find a company that can somehow put your investments in a basket that can be, you have peace of mind that you don't have to worry about what's happening in the news, that, you're always looking at your portfolio. Is it going up or down? Is it crazy? And my one idea is look for something that is going to be automatically rebalanced for you.
Okay.
Just that's my idea, because you can, if you have, if you want to take advantage of something and you're living, I'll take Spain as an example. If I'm living in Spain and I want to call my financial planner to do something, you can't ask the financial planner for what should I do. They cannot tell you. You have to call your financial planner and say, I want to buy this or I want to sell that. And if you don't have that experience or you don't know what to do, it's going to be difficult.
Yeah. So you tell me, when should someone approach you with their financial planning or when they're going to move?
Well, whenever they have questions, they should approach. So we like to have as long of a lead as possible, because we need to pull in experts like yourself. For example, like getting the information. It's true. It's all disjointed. Like, your expertise. I know my expertise. Logistics people know their expertise. But if someone's coming and saying, I'm next month I'm moving. Well, thank you. Good luck. We're happy for you, because a month is not even enough time to pull everybody in to start working on this. So if you have an inkling, 5 years down the road, I'm going to retire in Europe or in Spain or Dubai or wherever, Mexico, Costa Rica. If you have an inkling that you want to do that, it's best to start talking and interviewing, because, I might not get along with you or you might not get along with me. So you're going to talk with me, and then, let me try someone else. Let me research if anybody else does this. There's other people, you can find them. But start talking and start learning. If you have 5 years, you're going to start learning different things like, the rental income, the non-resident stuff. You cannot do it a month before. I mean, you can. Good luck.
Yep.
And then hopefully you're not going to have to pay any fees or penalties afterwards. And look for someone that is not trying to sell you an account.
Yep.
Look for someone that is going to try to get to know you. And you'll know that they're good, because if you tell them, hey, I'm coming in, I'm going to move, I would like to invest in this, they should refuse you without knowing you enough. Because if you have a license, it's almost like being a doctor or a lawyer or something. You wouldn't go to a doctor and say, I have a bad back and I think you should give me this because I saw this on TV. And the doctor will be like, well, let's see what the underlying cause is first before it. Same thing with accounting, financial planning. I want to do this. Great. let's hear all about it.
Yep.
And who's your family and all that stuff,
Yep.
and how does all the implications, because they don't know what they don't know.
I think the relationship and trust is so important.
Oh, yeah.
In our roles, and mine especially, in my accounting firm, it's a little bit different than being a regular resident. When you're a resident, you file your tax returns once a year. You may talk to your accountant once a year. When you're a non-resident, we have multiple touch points throughout the year. I need to know about your rental income, other income, etc. And it's a more involved relationship, same as financial planning and investment advisory. And I think a lot of individuals are not aware of the importance of speaking to someone like you. We come across situations where someone's decided to sell their house. Now they have $1 million in the bank, or maybe they inherited some funds. Now they're moving, they don't know what to do. So it's so important to speak to someone like you who can show all the different potential paths of investing. A lot of people are not aware of even what a RIF is or a LIF is or all these different things. So it's important to speak to someone like you for education purposes.
And one other thing I want to add on there, just to be clear, a lot of potential clients I've spoken to have this, they've even told me this underlying fear that we're going to tell them what to do.
Yep.
And that's not the case. We don't tell anybody how to live their lives.
Yep.
It's their life. If you want to do it, you do it. What our job is, you and I and other professionals, is to uncover all the things that might be bad for them.
Yep.
If they don't know about it. Our job is not to live their life. We have our
Exactly.
own lives to live.
Yep.
We have our own issues. But so let us figure out, here's the repercussion. You can do it this way, but by the way, this is what can
Yep.
happen, good and bad. Now you decide what you want to do,
Yep.
right? So don't be afraid that you're going to talk to someone. Actually, if someone immediately starts telling you what you have to do, that is a warning bell, in my
Yep.
opinion. It should be, by the way, we've looked at your whole situation, and here's what we recommend.
Yep.
And these are the benefits and drawbacks. And if you say you want to do something else, that's fine too, but here's the benefits and drawbacks.
Exactly. I always say to my clients, because sometimes people come to me and they're very concerned or scared of becoming a non-resident for tax purposes if that's their situation. I always say to people, my job is not to push you one way or another. My job is to consult and advise you of all the tax implications so you're aware. If your situation goes this way, then these are the tax implications.
Yep.
And if it goes this way, this is what you need to do. So it's very educational. At the end of the day, you are aware of all the rules and requirements, and it's up to you what you decide to do, whether you have a permanent move, how you structure your life, and how that looks for you.
Cool. Awesome. So we've talked a lot already. Do we need a break? Are we good for?
I'm okay.
Good. When I asked, then actually, it's a question that I've had not just from Canadians that are looking to move abroad, but of immigrant Canadians who are here temporarily working for a firm. For example, an international firm that brought their employees over, and they're here for like 10, 20 years sometimes.
Oh, okay.
They've had they made a life here. They have RESPs for their kids. And I'll say exactly what it is. I've come across a lot of workers from Spain that are working here, because I'm also part of the Spanish Chamber of Commerce
yes,
Canada.
amazing.
We've been there, and I've talked with a lot of people. And their big thing is, well, we paid into CPP, we opened up RSPs,
Yep.
but we're going to move back.
Yep.
And they also have a property back over in Spain.
Yep.
And they said to me, what is this departure tax? Like, how come I have to pay tax on my property that's in Spain? But I'm like, what is that? Can you talk about that?
Yes. Good question. So we hear about the big, scary departure tax,
Yeah.
and it may be so much money when people leave Canada, but it's case by case.
Yeah.
So
Ruby, talk about what in fact is deemed disposition for different types of accounts and properties.
great question. So deemed disposition has to do with departure tax, the big, scary departure tax item that people hear when they leave Canada. This applies to some people and it doesn't apply to others. There's certain items that are exempt from deemed disposition, meaning you don't have to pay tax on it. And deemed disposition means that CRA is seeing you sell and buy back at fair market value of that item upon departure, and they're taxing you on the capital gain. So items that are excluded from deemed disposition, anything in registered accounts like TFSA, RSP, life insurance, real estate typically, because tax is paid upon the eventual sale. Items that are taxed and have a deemed disposition and where departure tax comes in, foreign property. If there's a gain there, you're going to have to pay tax on the gain. If you have non-registered investments, this is where typically the largest departure tax comes into play. Meaning, it could be beneficial or not, let me not say beneficial. It could be very little or it could be a lot in your situation. If there's been a huge gain in your non-registered investments, let's imagine $500,000. That means half the gain, $250K, is added to your taxable income when you leave, and you're paying tax on that gain even though you haven't withdrawn those investments,
Right.
which can be a huge tax liability.
So, for example, if you bought Apple shares decades ago
Yep.
at dollars and now they're worth thousands,
Yep.
that will be a huge capital gain, wouldn't it?
Yes, it would be. And if there's an amount owing, I believe, of over 16K, there's ways to defer paying tax on the departure. Alternatively, let's say if you just sold your home and you have $1 million in your bank account and you're planning to leave next month, you can end up putting those funds into a non-registered investment. There's very little gain in a month, so you don't have to worry about a huge tax hit on your departure return. And an added benefit to that is in future, you've already paid tax upon your departure.
Yep.
So CRA expects you to report your capital gain and it be taxed in the country that you live. So there's a benefit to that. There's certain items that are taxable as a non-resident. However, non-registered investments, if you're putting your funds into an account before you leave and there's a huge gain, the capital gain is exempt in future if you're a non-resident.
So what I'm hearing is if you already have an investment in something that's not tax sheltered,
Yep.
you've had it for a long time,
Yep.
and you've never had to really worry about the capital gain because you haven't sold anything
Yep.
yet. You pay annually on dividends and whatever, but you bought it for $100,000 and now it's $500,000. Then that could be a huge tax implication. But then I'm also hearing that if you time it properly and if it makes sense for you, for your family, if you sell your house on the 31st of June, 31st of July, there's no 31st in June. There's 31st of July. You have your plane ticket on, the 7th of August.
Yep.
And in the meantime, you've done your research. You've picked a firm. You've opened up a non-registered. You put your money in there. Then basically, you've got like a couple of days of potentially some gain or not. But then you're free. It's
Exactly.
good. But then you just have to get the NR4s and all that stuff, and
Exactly.
you pay that. You do your taxes wherever your country is.
Correct.
Yeah. Okay.
Correct.
Now I want to answer on one specific thing because it's been a point of pain for a lot of people. Those people that are, whether they're Canadian and they have foreign investment property or they're immigrants to Canada and now going back, how can you get around paying any deemed disposition or departure tax on your foreign property? Can you do that?
This is a good question.
Is there a way?
I would say, first of all, there's reporting requirements. Right. There's a form called T1135, foreign income verification. Right. You have to disclose foreign property ownership and the fair market value of that. 2, as a tax resident, if you have foreign rental income, you have to report your foreign rental income and rental expenses to Canada. And foreign property, there is a deemed disposition, so you would be paying tax on that.
So Ruby, another question that I get a lot is, I've got a large RRSP. They already know that it's not a good idea to cash it all out at once and pay tax on it. So half of it is gone, right? So we already know that they're allowed to keep that when they're somewhere else. And at one point, they're going to start getting income from it when it converts to a Registered Retirement Income Fund, RIF. But talk about what are the tax implications of that with withdrawing from that kind of pension? What happens in Canada? What happens in the other country?
Yeah, this is such an important question because it really depends on the country you're living in and if there's a tax treaty in place. Yep. If you're living in a non-tax treaty country, the default tax rate of 25% applies across the board. RSP income, CPP, old age security, etc., even dividend income.
And that's whether it's $1,000 you're taking out or $25,000.
Yeah.
It's none of this like staggered withholding tax. If you were a resident, where it's 10% off of the first 5,000,
Yep.
it's a flat 25%.
Yep, flat,
automatically. And
flat.
the company that you have the RSP with, they take that off because they know that you're a non-resident because you told them. That
Correct.
You're non-resident.
And they should issue you a non-resident tax slip, NR4 slip, showing how much tax was withheld.
Right.
That's if you're in a non-tax treaty country. Living in a tax treaty country, different countries have different withholding rates. And the benefit of living in a tax treaty country is they allow options for you to pay less withholding tax on retirement income, such as RSP, CPP, old age security, and even on dividend income as well. So as an example, in Spain, because it's a tax treaty country, if you're taking a lump sum payment out, it's a flat 25% again. I don't recommend taking a flat amount out, a lump sum payment. It's a huge chunk. In a tax treaty country, if you're taking a lump sum payment from your RSP, CPP, etc., it's still a flat tax of 25%, which is huge. So I always recommend taking periodic payments. That's the technical wording on the CRA website as well. And with tax treaty with Spain, that allows for reduced taxes of 15% automatically. In UAE, for example, even with the tax treaty on RSP, CPP, it's 25%. So that displays the difference on the different benefits of different tax treaties. And you can always look into that. A little tip. If you Google non-resident tax calculator, a page on the CRA website shows up. You can choose different countries and you can choose the type of income you plan on receiving, and it'll show you the default tax rate and if there's options to pay less tax as well, which is a huge benefit if you live in a tax treaty country. So when living in Spain, for example, even with the reduced tax treaty rate of 15%, which is great, there's an option to submit a form called Form NR5, application for a non-resident to reduce the tax withholdings they're paying. And this form is, if it's approved, it's approved for 5 years at a time, so you don't have to submit it every year. And they may reduce the withholdings from 15% to 8% to 12%, etc., whatever they choose. So let's assume NR5 form is filed. It's approved for 5 years. Now the payer of the income to you, such as CPP, old age security, RSP, is applying the reduced withholdings. When you receive reduced withholdings, you're required to file a tax return called the S217 Section 217 non-resident return by June 30th of the following month. Because they allowed you to pay less tax, they want to make sure you're being taxed on your income, and they want to know all the income you're earning worldwide as well, just for disclosure purposes. If you fail to file that tax return by June 30th, they cancel the NR5 form and they ask you to repay if it's up to 25% or 15%. So that is a benefit on the Canadian side to file the NR5 form. And on top of that, if you have a private pension that's not CPP, old age security, etc. with the government, there's an additional form called NR301 to reduce withholdings, and that can be given to your private pension.
So it really highlights the point of if you're going to be over living your life, you're going to need your accountant in your new country. But if you still have stuff back in Canada, hiring a firm to do this for you so you don't forget, because all these penalties, if you miss a deadline, is really important.
Yeah. And to add to that, let's say NR5 form is not filed, 15% is being withheld or 25% is being withheld, and you receive NR4 slips showing how much income you received. You still have the option to file a Section 217 return by June 30th. So that NR5 is not make or break. You can still file a tax return and be taxed the same as a tax resident to receive a refund.
But one question, and I think I've come across this, filing taxes in Canada, while it might not be fun, is pretty easy. You can get software to work with an accountant, press a button.
Yeah.
But if you're not living in Canada, I've heard that you actually have to paper file.
Yeah, good point. Actually, great point. As you said that, I was going to clarify a lot of tax returns. So once you become a non-resident, there's various tax returns that can be filed. As a tax resident, you're filing a T1 regular resident return. When you're a non-resident, there could be a non-resident rental return. There could be a non-resident retirement income return, the Section 217 return. There could be a non-resident income tax return for employment income, or if you sold property, reporting your final sale of property and capital gains tax. So first of all, we need to make sure the right tax return is filed. Most tax returns for non-residents are paper mailed. There's a requirement because there's different elections and forms required. So we manage all that. We put our mailing address for all of our clients. We express mail everything. We have proof that's mailed.
So you DocuSign stuff and then you print it?
Not DocuSign. Okay. Actually, CRA requires for certain returns that it's a physical signature. Okay. So we ask the client to print the page, scan it back to us. The one page, the signature page, and then we'll express mail the tax
So they don't
return.
mail it, they sign it, scan it, email it.
Yeah.
Then you print the rest of it, add that, and that makes sense.
Yeah.
Okay.
CRA makes a lot of mistakes too. So we stay on top of that. We're authorized CRA representatives for all of our clients. I'll give you an example. And I feel awful for my client. We filed his departure return. I believe he had immigrated to Canada maybe 25 years ago or so. We filed his departure return. CRA made an error indicating that he immigrated to Canada in 2024 versus emigrated. Okay. So then they charged him $50,000 in TFSA penalties because they had marked him a non-resident for these past 20 years or so.
Oh boy.
So you can imagine $50,000 in penalties, etc. So we had to submit T1 adjustment requests. We had to request that they reverse the TFSA penalties and arrears interest, etc. they charge. So we help with all those issues. CRA makes mistakes as well, unfortunately.
Do you tell the CRA you're leaving, like there's that form or whatever, or do you just move and then you do your final taxes?
Good question. And I know you said the form or whatever. I know what you're referring to. There's a questionnaire called NR73, a questionnaire for the CRA's opinion of your tax residency.
Right. So if you don't know what it is, you can ask for the opinion.
We don't recommend that too often.
Don't do that.
No, it depends. As an accounting firm, we don't recommend that because it's a long form of 70 plus questions. And depending how it's answered, the CRA can give you the wrong opinion, which could result in you missing out on tax withholding requirements on rental income, etc., missing out on NR4 slips.
Right.
We've had situations where a couple has filed their own questionnaire. One individual has received one opinion and the other another. Yeah. So unless your situation is extremely convoluted, we may ask that you submit the NR73. Typically, we assess your situation and we advise based on your circumstances.
And then when you're in the new country, you have to do your taxes anyway for the previous year. You have a firm like yours that you sign the thing, they scan it to you, you submit it. And at that point, I think there's a question if you've sold your property and if you've left Canada, there's a question on those.
Yes. So typically for us, step one, we do the consultation, keep us informed upon your departure.
Right.
If there's tax requirements that kick in right away, let's say maybe you're earning rental income or dividend income, etc., we'll advise what's needed right away. Then the actual tax filing requirements, because as a non-resident, we want to think about tax withholding requirements and tax filing requirements. The actual tax filings are typically due April 30th or June 30th.
Okay.
So we start preparing tax returns around February. When you leave Canada, we file a different sort of tax return, which we call the part-year departure return. Different forms and elections about property ownership, non-registered investments, foreign property, etc. So we make sure everything is filed in a timely fashion. There's no penalties, interest, everything's updated correctly. Mm-hmm. And then actually, the year you leave Canada, the year is typically broken into two periods, the resident period and the non-resident period. So you may actually have two different tax returns in Canada to file that year, the part-year departure return and a potential non-resident return if you're earning some sort of non-resident income.
Okay.
So we manage all of that. And then typically the year of your departure, there's multiple filing requirements, etc. After you leave, it becomes habitual depending on the sort of income you're earning. Or if you're not earning anything at all anymore, you may be done with filing Canadian tax returns, which is awesome as well. You don't have to worry about CRA waiting for your tax return or waiting for you to report your worldwide income. That final paperwork, the final departure return, CRA will update your date of emigration when you become a non-resident. At that point, they will update your benefits and credits. They'll ask you to repay any benefits you may have mistakenly received as a non-resident. Mm-hmm. Even if you call CRA and say, hey, I'm leaving tomorrow, stop my benefits, childcare benefit, GST, HST credit, etc., they typically don't stop the benefits until they receive your actual departure return. So a little tip, if you're receiving childcare benefit or any other benefits, put that money aside because you will have to repay it.
I love it. I think that's a second pro tip I've heard. Is there, in your opinion, a better time of the year to leave? Is it January or December, or does it matter?
I don't think it matters that
Okay.
much in the big picture.
Tax-wise, I mean, like,
Tax-wise, the only implication, not only, one of the implications I would say is depending on when you leave Canada, your provincial and federal credits are prorated. So that can result in a little bit more tax owing because you're not receiving the full year's benefits. Otherwise, your worldwide income is no longer taxable after you leave Canada. So it all depends on a few different factors. When are you going to start earning the income overseas?
okay.
Because some individuals, here's another tip. Let's say someone is starting a job in Spain and that employer is giving them
Which is
relocation.
a totally different, another,
Yeah.
it's not just retirement now,
Just-
it's earning income
Yes,
now, right?
earning
Yeah.
income too. Often employers will give their employees relocation fund, like a few $1,000s to relocate. I always recommend receiving those funds after you move from Canada, or it can be a taxable
Yeah.
item in Canada. So things like that. Timing matters.
You know, we haven't talked about we talked about retirement. What about, let's go into this segue here about working.
Yeah.
Whether you're planning to retire, but maybe you want to get a second job and stuff like that. Digital nomads is a big thing since the past 5 years or so. I've got friends and family and clients that their kids have been working in Mexico or Portugal or whatever. Can you talk a little bit about, they're not going to be non-residents, I guess, but they're working around the world, or?
Good question. So I would say the term digital nomads itself is not I don't believe it's a definable term in CRA's eyes or as
Right.
the Income Tax Act. So when we say digital nomad, your understanding may be different than my understanding. For me, digital nomad could be you're living and working 6 months in Bali, 2 months in Mexico, back in Canada.
Yeah, but you still have a residence back home.
Yes.
So you're still then technically a Canadian resident making money around the world.
Maybe. I wouldn't default
Okay.
to that. Or, maybe you're traveling around for 2 years being a digital nomad. You're not coming back to Canada at all. Or let's imagine you are a digital nomad now in Spain with a digital nomad visa, because there's various digital nomad visas in different countries. When we consider the tax residency of digital nomad, we have to look at the primary ties, secondary ties. Where do they ordinarily inhabit? What is the intention, the length of stay? Everything has to be looked at. So I would say it's not so much about digital nomad. It's about their primary ties, secondary ties. Have they set up residency elsewhere? Do they have a long-term lease in place elsewhere? The whole situation needs to be looked at again.
Okay.
Yeah.
Okay. So that's a whole other topic. It includes even visas, because you can't just decide I'm going to go stay somewhere for 6 months. It's not a tax question anymore.
Yeah.
It's also like, can I actually do it? But it's definitely a hot topic that I've come across with a lot of even my nieces and nephews that are just finishing university and they're looking to do stuff around the world.
Yeah. And this is a good point, which kind of ties into, we hear about the 183-day rule.
Yep,
And I
talk
want
about that,
yeah, the 183-day rule is not a default rule, meaning,
Tell us what it is first, because some people might say, I've heard about that, but not exactly.
well, let's just say there's a lot of confusion about the 183-day rule.
Yeah.
People often assume that if they're default in Canada for 183 days, they're a
Right.
tax resident, or if they're default out of Canada for 183 days, that they're a non-resident for tax purposes.
Yeah.
And that's not exactly how it works.
Okay.
You could be out of Canada for a 183 days.
Yeah.
You still have your residency, your habitual abode. You haven't set up residency elsewhere. You're traveling around. You're still a Canadian tax resident. Now,
But I wonder though, you're a Canadian tax resident. I wonder what the other country might think if you stay there longer than 100.
well, it depends what you're doing on those
Right.
days that you're not in Canada, because you could be in different countries.
Yeah.
Or you could have established residency in that other place.
I know that the U.S. is very strict about if you stay longer, they might tax you.
Yes. Well, the 183-day rule ties into, on Canada's side, on the Canadian tax
Right.
perspective, if you're considered a deemed resident because you've spent 183 days plus in Canada and because you don't have residency elsewhere, then CRA may deem you as a tax resident because you spent that time here, you don't really have residency elsewhere, and now you've set up some ties, or even if you don't have ties, you're default deemed resident. Alternatively, you can be a deemed non-resident, meaning you've spent over 183 days here. However, maybe your spouse, your children are in another country. You're planning to go back. Your intention is to go back. You're here for only a set period of time. So 183-day rule is not a blanket rule. We have to look at what's happening. What was your intention? As an example, you could leave Canada January 10th, you're here, or December 10th. You're here for over 300 days. You become a part-year non-resident effective your departure date. So even though you spent 183 days in Canada, you're not a tax resident for the whole year. So I would say the 183-day rule is not black and white. We need to look at your situation in case that deems you as a resident, deems you as a non-resident, or if you're actually a non-resident for tax purposes, or a resident, because there's different tax statuses.
Okay, cool. I'm trying to think of what other questions. I know there's so many questions that come up. It's usually around the residency, the tax treaties, and the withholding of the pensions, right? When you are in another country, and they've got dividends and capital gains coming from non-registered accounts, like what exactly is taxed? Are capital gains taxed once you're non-resident? Are dividends taxed? Or is interest payments taxed? Like if I have a GIC and I'm getting interest payments back in a bank account in Canada, does Canada tax that interest? Do you know?
It's a good question. It's a great question. So it really depends. CRA has different rules. Some items are taxable in the country you earn income.
Right, okay.
Meaning if the income is paid out in
Portugal.
Canada or Portugal, it's taxed there. Or it's dependent on where you reside. So for example, capital gains is typically not taxable in Canada as a non-resident anymore. It's taxable where you live. Certain items are taxable Canadian items, such as Canadian property. Canadian real estate continues to be taxable in Canada, but non-registered capital gain is not taxable in Canada.
Okay.
Dividends, dividend income paid from Canada is taxable in Canada.
So if you got like $1 million in a non-registered account and you have all the bank stocks that pay you dividends regularly, those dividends are taxable.
Yes, and on the Canadian side, the payer is required to withhold non-resident tax, either 15% or 25%.
Right.
Yes,
Okay.
and then you receive the NR4 slip. For example, interest income is exempt from non-resident tax.
Okay.
So you would receive an NR4 slip, tax is not withheld. That
Okay.
interest income is typically taxed where you live. So that's
Gotcha.
important to keep in mind.
So $1 million guaranteed investment certificate, GIC, that, I mean, I don't know if it's 4% anymore, but let's say it's 4%. You get $40,000 of interest growth. If you were in Canada, I know for sure you'd be paying tax on the interest. But what you're saying is that if you're somewhere else, that interest income is not taxable.
Correct.
Gotcha.
That is typically correct. Now,
so just get yourself $1 million GIC and that's guaranteed.
And another key important thing, which I'm sure they should discuss with you in detail, is if the investments include U.S. foreign investments and different things like that, because then there's U.S. withholdings potentially, even though it's a Canadian investment. So it can be nuanced.
Yeah.
It's not always black and white.
Yeah.
Typically, though, interest income is exempt.
This is good news. So interest is exempt, typically.
Yep.
I would say typically, capital gains, but dividends, and do we know the rate of tax on dividends? Is
It could be 15% or 25%, depending on the tax treaty.
Tax treaty thing.
Yeah,
Gotcha.
depending on the tax treaty.
Okay, and then in their country where you're now resident or paying taxes, then you would have to tell them of any capital gains or interest or through their slips or whatever that come to you, and then submit that there through the accountant.
Yes, and depending on the country you live in, they may be taxing unrealized capital gains in certain accounts. So it's important you discuss these items. I had a client, they were taxing her unrealized gains in ETFs. I can't recall where she lived at the moment, maybe Switzerland. I can't recall, I'm not sure. However, she had to move her investments in her accounts. So what I had suggested is, let's say you need to move some investments. You always want to ask the brokerage to do an internal transfer instead of you withdrawing and recontributing. Let's say if you need to, let's say if Wealth Simple doesn't hold your account anymore and you need to move it to Questrade, rather than withdraw, let's say from a certain account
Yep.
and reinvest, you want to ask the company to do a transfer.
Yep.
Yeah. It's
Always
key.
recommended.
Yeah.
Yeah. Once you withdraw, you're basically deemed disposing of
Exactly.
to your bank account. Yeah. So
And it'll take up your contribution room
Yeah.
if you have contribution room. Yeah.
for the TFSA, 100%. Yeah.
Serge, so tell me, I know a few of my own clients have worked with you and you've helped them plan their investments before their departure from Canada. What does that typically look like? What do you see a lot of people doing these days?
Yeah, sure. Thanks, Ruby, for the question. So let's talk about the investments. And I touched a little bit about it before. Number one, you need to find a firm that can still hold your accounts. That's 100%. You don't want to be in another part of the world and you have no access or it's super restricted. And you need to know the rules. Like a lot of people are kind of, they have a good relationship with their financial planner over decades maybe. And all of a sudden they tell them that they're going to move and all of a sudden the financial planner doesn't want their business anymore. Not because they don't want the business, but number one, they can't hold the account, or they can hold the account, but they don't have that relationship anymore. For example, they can't do annual reviews. They can't do like, hey, here's what we hear in the market and here's what we recommend to. It's now against the law to actually give advice if your client is not in your jurisdiction.
Even if they already have the account with you.
If they have the account, they can keep it in some cases,
Okay.
depending on the firm. But if they are not physically in the location where you're licensed, where you open the account, even in Canada, for example, like I'm licensed in Ontario. If one of my clients moves to BC, unless I get a license in BC, I can't give them advice. They can keep the account with me, no problem, but then I can't give them advice. So typically we'd say, find another planner in BC, even at our own firm, and that's fine. It's a bit more difficult when you move to a place like a European country or whatever, because number one, you don't know what financial planning is like there. And I'll be quite honest with you, I don't know if it's at this level of, even here in Canada, it's taken years to get from being just a salesperson of mutual funds or stocks to being a holistic financial planning firm. It's even today, a lot of clients see people in my profession as, you're going to tell me what mutual fund to buy or what stock to buy because that's what you do. And that's not exactly what we do anymore. That's the easiest part, finding the right investment for you. But going back to that, hey, I've known you for 20 years. You're planning to move to Italy. That's fine. We can hold your account. But when you're in Italy, you just have to know if you need advice, you can't ask me because I can't tell you.
Yeah.
And the reason for that is because we don't have a license in Italy. But what you can do, we can leave it here. And if you need money, you can call me, WhatsApp, whatever, or send me an email saying, I need $10,000. And you've already set up your bank account in Canada. And then we send it to your bank account in there. And then you decide how to move it over to Italy, whether using one of the Forex exchanges or whatever, not Forex, Knightsbridge or Wise or whatever those firms are that you would convert the money. But it's got to be very clear that if you ask, hey, I heard something happened in the news about a war or this or that, are my investments okay? We can't even answer that.
Wow.
We can just say you have investments. And we can officially send you your statements, we can officially send you your tax returns, and that's it. So it's one of the things I say to clients is, this is why we need enough time beforehand, because if you're going to leave let's say you sell your $2 million home, you pay off all your debts and you're left with $1.5 million, and you just want to park it somewhere safe for the next couple of years while you figure out your new life situation. Well, what I like to do is I like to make sure that we plan everything in advance. We decide how much and put in a bucket that might be more aggressive for long term, whether we should keep it conservative or whether we just keep it as cash. Like that could be okay as well. And once we've decided that, then we pick the investments before you leave. We agree that this is a longer term investment. Like if you say, I'm moving to Italy and I'm going to need $100,000 or $200,000 or $500,000 to buy a property within the next 12 months, then normally that will not be invested. That will be just kept safe. You can even put in your bank account, or you can even move it over to a bank account over there. We're talking about if you're 60, and you have another 30 years to live, maybe more, because now you're going to the Mediterranean lifestyle, Mediterranean diet, and you're going to live longer because you're in the blue zone somewhere, right? So then now you need that money to work for you much longer, and then we'll figure out a way to invest it to keep it going longer. But in a type of product that will automatically rebalance for you, so that if you've got pockets of money in Canada, US, internationally, you don't have to worry about me calling you and saying we should rebalance because we made a lot of profit in the US. Let's take that profit and move it over here. We can't do that anymore. But if we have a product that's automatically rebalanced and they are out there, research them, then you don't have to worry about that because it's going to stay in that either conservative level or very conservative level. So that's one piece of advice that I would definitely say you want to do. The next piece of advice is really get to know what your plan is. And this is difficult because I've had so many experiences, and you can go on YouTube, by the way, and search stuff, and you'll see lots of Canadians that left, and then a year later say, I wish I didn't leave Canada, I'm coming back.
Yeah.
So you don't know. You're going to land somewhere, and you're like, you went on vacation there before, like for 2 weeks, and you fell in love with the place. And now all of a sudden you rent a long-term rental, and you don't like the weather in a certain month of the year, or you kind of feel that you're stuck there and you can't go anywhere else. One rule of thumb, one pro tip, I'll give a pro tip too, and this is recommended by a lot of immigration consultants and relocation consultants. Take some time if you're going to retire, like take 3 months. You don't need a visa for that. Take a month and just go different parts and see if you fall in love with the place. And even then you might think, I love this place. I'm going to get my, in the case of Spain, non-lucrative visa or whatever visa. And you go through all that. It's not a difficult process, but it can be cumbersome. You got to get a police record check. You got to have enough money in the bank. You have to have health insurance. You have to have all of that. But that still might not work. You might still decide to come back. So before you even get into all of that, like you're retired, like go have some fun. Take a vacation, take a month, 2 months, see if you like it. And then if you're not quite ready, just do slow travel. Live in Canada and go back and forth. And then when you've done it a couple of years or months or whatever, now you feel really confident. You know what? I heard what Ruby said. I'm not going to keep this here. The cleanest way is sell everything. And I'm so confident I'm going to be a non-resident that I'm not going to have to worry about NR4s and all that stuff. I'm just going to get it all done and move. And then that way, you've put your foot in the water, you've got acclimatized to it, and now you can live your best life. And maybe even your friends know that's happening, so that's all taken care of. So really for me, again, I said at the beginning and I'm saying it again, financial is super important to make sure you're not going to be either a burden wherever you're going because you ran out of money, or you can't enjoy the life that you thought you were going to have because you ran out of money. So definitely you need to have not just a financial plan that says, oh yeah, you have enough for 3,000 euros a month. No. If you're going to spend 3,000 euros a month, you need to have a plan that has 4,000 or 5,000 euros a month because health concerns, different things that happen, maybe a family member passes away back in somewhere else, you have to take time, or caregiving, you have to go back and do some caregiving somewhere else. Make that buffer in your financial plan to make sure that you have more than enough to live your life. And maybe the answer is you can't. Like there has been cases where we met with clients and they're leaving Canada for maybe not the right reasons because it's too expensive here, whatever. And when they're moving abroad, they're basically going to be making ends meet there as well because whatever they've created here. And so sometimes it's not all about, rose-colored glasses that it's going to be a great life. Mm-hmm. But it still means that you need some financial planning. So when we talk to clients, definitely we'll figure out, can it be done? Yes or no. If it can't be done, I'm going to go back actually in my own personal history. Before I was a financial planner, I tell this story all the time. when my wife and I at the beginning were looking for our first mortgage, and we were just starting out, barely any income, student debts for me, whatever. We walked into the first bank, and they basically just looked at us. It was a new kid bank, a mortgage guy, didn't even want to give us the time. No, we can't. Bye. See you later.
Awful.
We were so dejected without even asking a question. But we were determined. So we found another person. We went in. She was more seasoned, meaning a little bit older. She had experience. She looked at it. She goes, Serge, we can't give you a mortgage today. But this is what you need to do to get a mortgage. Mm-hmm. And she spent the time with us, like a whole hour, to say, if you do this, pay off these debts, cancel this credit card, save this much money, maybe get a higher paying job, whatever. Come back in 6 months and we'll see what we can do.
Yeah.
Now that was so powerful because all of a sudden we had a plan.
Yep.
Right? So again, if you're 30 days before you leave and you come to us, like even if we can give you a plan, what if it doesn't work? Then what?
Yeah.
Then you're in trouble. But if you come 5 years before, okay, it can't work today, but this is what you need to do to get there.
Yeah.
All of a sudden you have a plan, and that's just so powerful. Guess what? 6 months later, we went back. We did exactly everything she told us. We got our mortgage, and the rest was history.
Yeah.
Because we bought like in 1998 when mortgage rates were 7%, but it was kind of at the beginning of a real estate boom.
Okay.
We bought our first property at $230,000, and we sold it a year and a half later, and we made a profit of $50,000.
Amazing.
Yeah. So that's the power of having time and talking with the right person that has your back, basically. Yeah. And you're not going to know if they have your back until that trust is there. Yeah. And how do you build trust? You talk with people.
Yeah.
Right.
And thank you so much for sharing that. I exactly believe in the same thing. Plan, prepare, and be aware of your. Serge, thank you again for having me and having this wonderful conversation. It's so important as people continue to move abroad, and there's such a surge right now. Last year, actually in 2024, over 100,000 Canadians have taken that step to move abroad, and there's just more and more leaving. And we're here to help you, guide you throughout that process. Feel free to reach out to me at 360globaltax.ca, info@360globaltax.ca. If you're planning to move abroad, it's important to be aware of your departure and post-departure tax implications, and it's what we do every single day.
Thank you, Ruby. And really, I'm just really happy to have you as a guest on this podcast. I would suggest that if anybody has questions that have not been addressed, put them in the comments below, and I'll be certain to share that with Ruby. Hopefully, we'll have future sessions as well. I want to thank you for joining this community, and because I know it's difficult. I know it's difficult to get the right answers and the right questions, and who do you trust. So please also, if there's something that you want to hear or learn more about, put them in the comments. A couple of weeks ago, someone was asking me, do we have a tax expert in Greece or Panama? And the reality is, no, I don't. But I wouldn't even be looking for them if you didn't ask me for them. And I've actually started reaching out to those people as well. So thank you again for watching today. We hope it was valuable for you, and we'll see you next time.
Thank you.